Markets have been buffeted by forces from various sides. Investors' main preoccupation has been the tensions between the US and China and their impact on company confidence and investment. We have seen signs of an improved tone in communications between both countries. Even the US and China are firmly entrenched in their positions. They've been careful to avoid inflicting substantive economic and financial damage on the global economy. We expect a period of thaw to continue until an expected meeting between Presidents Trump and Xi in Chile on the side of the APEC meetings on November the 16th. However, we have learned from recent rounds of negotiations that both sides are still very far apart on substantial issues. In Europe, the continent is affected by poor sentiment in Germany. Business confidence is particularly affected by the trade tensions. Uncertainty around the Brexit negotiations have not helped. The attack on Saudi Arabia remains an important concern, even though there have been very little escalation so far. Central banks are trying to counteract the uncertainty around trade and other issues by easing monetary policies in various ways. They have been quick to cut interest rates. They have resumed bond buying operations and have signaled to markets that they would keep rates lower for longer. These actions have been possible thanks to the contained level of inflation. Bond markets were the first to react, and other markets have been stabilized. The US housing market has been performing strongly, which is supportive for the important US consumer. US manufacturing sentiment has also stopped declining. The US 2020 elections have now become the market's focus. The impeachment proceedings are more procedural than a real threat on the US presidency, but the noise over the next few months is likely to limit policy implementation and could cause more volatility in presidential communications. In this environment, we recognize that expectations of a trade deal will be a short-term positive for Asia, but the most we expect so far is a mini deal focusing narrowly on China buying US farming products versus some limited tariff relief on Chinese exports to the US. So, we remain slightly cautious by keeping our underweight to Asian equities despite the region's equity market underperformance since the start of the year.